Welcome back, everybody, to Volatility Trading Strategies. So I've got a good one today that I think all of you volatility traders out there are really going to enjoy. Because I can't tell you how many times I've heard someone say that in order to make money, all you have to do is wait for the VIX index to spike up really high, and then you buy a bunch of put options. If I had a nickel for every time I've heard someone say that, I'd be making this video from my yacht in the French Riviera. Unfortunately, everybody and their dog already knows that the VIX index is mean reverting. Now, it's more accurate to say that it's mode reverting, because as you can see here, the VIX does spend the majority of its days with a 12, 13, or 14 handle. But the point is, everybody already knows the VIX index reverts back downwards after a big spike. Why would there be any edge in a trade that everybody already sees coming a mile away? And I see the same thing being said all over Twitter about volatility ETPs as well. Everybody already knows that those long vol ETPs do trend downward over time. So there's no edge in just blindly shorting them. I know it helps those people get followers on Twitter by just saying, hey look, the UVXY goes down. Let's sell some spreads. Let's sell naked calls week after week. It's easy money. But I'm sure you've noticed, none of them ever actually show their performance because trading doesn't work that way. In order to make money, you need an actual edge, above and beyond just noticing that volatility ETPs tend to go downward, or that the VIX index reverts back to the mean after a big spike. So today I'm going to go over several examples of this most recent VIX spike where it went into the 80s, and see what would have happened if someone did actually buy those put options. So subscribe to the channel and please do smash that like button for me. These videos are pretty time consuming to make, but I do like to give you your volatility fix. So let's talk about VIX index put options. So let me dive into my Thinkorswim trading platform and actually answer the question, would buying put options after a VIX spike actually work? So just for some context here, this is the VIX index since it launched about 27 years ago. Now the long-term mean is 19.37, the long-term median is 17.17, and the long-term mode is about 13. So when we ask what's an average VIX price, of course that depends on what type of average you're talking about, but just taking those three metrics, we can say that the average VIX is about 15, give or take. So it's natural for people to assume that all you have to do is wait for one of these big VIX spikes and then go hard on the put options. Now the question is, does that actually work? In order to actually find that out, we're going to use the function in Thinkorswim called ThinkBack. It's a function that you can use to see what a trade would have done had you taken it. So we'll just check out the VIX index for just 2020 here. And it actually set the record for the highest closing print that the VIX has ever seen, even higher than at the height of the financial crisis in 2008. On March 16, 2020, the VIX index closed at 82.69. So the first test I'm going to show you is what would have happened if a trader waited until the VIX index crossed over 50 and then bought a put option. We can see here the VIX crossed over 50 for the first time on March 9th, 2020. So we'll go back to the Think Back option, input the VIX here, and then we'll add in that date of March 9th. You can see it here, March 9th, 2020. The VIX index closed at 54.46. So seemingly a great time to start buying put options. The VIX very rarely gets over 50. So we'll go down to the expiration months here. We'll give ourselves plenty of time for this trade to materialize, and we'll select this 17 June 2020, 99 days to expiration. Now I'll show you what happened on a couple of these strikes, but the first one we're going to do is right at the money there, the 50 put option. We're going to buy to open a single long put. Now remember, because each one option contract represents 100 shares of the underlying, this put option costs about $2,325. Now down here is what's so great about this Think Back option. We can see how that contract performed during its life cycle. Now as we know, the VIX didn't stop at 50. It actually went over 80. So 1 week in here, you can see it's already down $1,120. That's down 48% in just a week. But fortunately for this put buyer, there was an epic stock market recovery afterwards. In fact, one of the strongest in the history of the S&P 500. Now, of course, that's exactly what you would want to happen if you bought this put option when the VIX spiked upwards. So the first point of interest here is right here on the 3rd of April. This is when the VIX index crossed back below 50 for the first time. And we can see on this day that contract is still down $660. That's 28% of the value of this contract gone, even though right here the VIX is at 4680 and we opened this when it was over 54. But it's already taken a substantial loss. And it actually took the VIX index getting down to about 25, this happened on June 5th, for this put option to finally break into the profit range. And you can see not by very much at all, up $150. That's just a 6.5% gain on this contract. It was down the entire time, at most about 50% loss, and on the very best day it was only up 6.5%. And then of course immediately afterwards it's back down into negative, and then a week later the contract expires for a loss of $692. A total loss of 30%. Imagine that, a trader waits for the VIX index to get to 50, which only happens a few times per decade by the way, and then gets one of the most epic stock market recoveries in history. That's a dream setup. And yet there was only one day where that trade was even profitable, and only by $150. Overall, that trade lost 30%. As I said, that's what happens when everybody in the world already knows about an expected outcome. There's no edge there. Okay, so let's clear this 50 strike off. Obviously that one didn't work out very well. And let's do something a little more out of the money. So we'll see what happens to this 30 strike when we buy to open a single put option for $610. Remember, that's $610 of capital outlay. If we go to the think back down here and we expand it, well, we can see this one is actually even worse. Within a few days, this one is actually down 60%. And then at no time during the life of this contract was it ever actually up money. Not even on that single day where the VIX shocked us. Down from the 80s to below 25, as low as 23.54 on this day, and this contract was still down $50. And just like the first one, a few days later, it's right back into the negative. And this time, a complete loss of capital. It is totally out of the money and it loses 100% of its value. Now, you may be shocked to see this at first, but if you think about it, it does make sense, right? The options market is very efficient, especially in the volatility space. These are not rookie traders playing with VIX options. These are sophisticated investors deploying advanced hedging strategies. Why would a trade that everybody knows about work in an efficient market? The answer is it wouldn't. Okay, now let's get really silly here. Let's pretend that a trader put on one of the most well-timed trades in history. They waited until the VIX index spiked to over 75 before putting on their trade, which of course outside of the financial crisis has never happened before, so that would have been a very high level of discipline to wait that long. But let's go forward until the 12th. We can see on this day the VIX is at 75.47. We'll clear this one off. And just for consistency, we'll use the same month, 17 June 2020, 96 days to expiration. That's well over 3 months. Should be enough time to see a big profit, right? Well, we'll buy to open one of these 30 strikes, which of course is well outside of the money. This thing costs $475. Remember, you always multiply by 100 with options trading. Now, if you put yourself in a position of a trader like this would be an unbelievable long shot, and you'd probably expect to get paid very highly for it. VIX over 75 and you buy a 30 strike put option? If it gets there, it should be a big win. But when we expand this down below, we can see that it wasn't a big win. A week later, of course, right out of the gates, it's down a massive amount of capital, and it really didn't do much since then. Right here, not very long after the contract was opened, the VIX is already in the 30s, yet the contract is still down money. Goes way negative again, and then if you're ultra patient, you get another opportunity to close out the trade for a $5 profit. On this day, the VIX is now in the 20s, closing at 27.57, and you can scoop up your $5 profit. And of course, if you just let it go right to the very end, as it turned out, there was that day when the VIX dipped as low as 23.54 that the contract was actually up $85. Perfect timing, unbelievable patience and discipline for an 18% profit. And then just like the others, it goes on to expire worthless. So before watching this video, be honest, how many of you would have been surprised if you bought a 30 strike put when the VIX index was over 75 and then you got a really fast recovery where it went all the way into the 20s and you still lost money? A lot of people just don't understand how option trading works. Now, before we get into the reason why it's happening despite that dream setup, shameless plug here, but beyond managing the VTS service, I do also manage a dedicated option service called VTS Options. If you're confused and you actually want to learn about these things, hint, hint, there's a free trial on the website, go check it out. But anyway, why is this happening? How is that even possible? Well, the short answer is, long put options are what's called delta negative and vega positive trades. Delta is the Greek symbol that represents the option sensitivity to price or direction of the underlying. So delta negative means the position gains value when the price of the underlying goes down. And Vega is the Greek symbol that represents the option sensitivity to volatility. Long puts are Vega positive, meaning the position gains value when volatility rises and loses value when volatility goes down. So when the VIX gets to those extremely high levels, volatility is by definition through the roof. And that means those contracts, when you buy them, are as expensive as they get. So even if the VIX does go back down, as you want it to because you're delta negative, it means that despite getting the direction of the trade absolutely correct, it can still lose money. In the case of VIX options, oftentimes the effects of Vega outweigh the effects of delta. That's how you can end up with a trade that was perfectly well-timed, absolutely correct in the direction, and still lose money because that Vega got crushed. Now that's not always the case. Sometimes you can eke out some small wins here and there, but the point is, it's very far from the slam dunk trade that many people out there think it is. I did another video back in March, right at the height of the crisis, and in it I talked about 2 ways to successfully short the VIX. You can check that out here after. One of them was a put vertical spread, and the other one was a butterfly. Both of those trades can work out a lot better because the Greeks are more well aligned. And if you understand position sizing and how to add layers of risk management, then you could also consider short strangles or long calendars and diagonals. Those are all trades that have a better chance of making you money when you're shorting a VIX spike. Now, if you don't know what those things are just yet, that's totally fine. You can learn. If you're intrigued, you can claim your free trial on my website and see if the VTS community is right for you. See you next time. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.